We're about to see a shocking housing crash that's unlike anything we've seen before. Over the past few years, home prices in the U.S. have gone up by nearly 40%. Now, mortgage rates are going up at a rate that's hard to believe, and they're likely to go up even more in the next few months as the Federal Reserve continues to fight inflation with all its might. Higher mortgage rates mean that people will have to pay more for their mortgages. Simple economic theory says that neither home prices nor incomes can grow faster than the other for very long. This is not sustainable, as economists at the Federal Reserve Bank of Dallas pointed out this spring when they warned about the risks of the growing housing bubble. The fast rate at which home prices were rising couldn't keep up for so long, which is why recent headlines have been warning that a reversal has begun. A study by Moody's Analytics that looked at whether economic fundamentals like local income levels could support local home prices found that, on average, U.S. home prices are overvalued by 24.7%. This means that, given current income levels, U.S. home prices are 24.7% higher than they would have been in the past. On the other hand, this also means that if the Federal Reserve keeps raising interest rates through 2023, we are likely to see a drop in home prices. 344 of the 414 largest housing markets in the U.S. have home prices that are higher than they should be by more than 10%. 183 markets are worth more than they should be by more than 25%, and 27 markets are worth more than they should be by more than 50%. Some of the markets that became very popular during the pandemic, like Boise, Idaho, and Phoenix, Arizona, are overvalued by 72% and 54%, respectively. But it's not just how expensive housing got, it's how fast it got there. In just 24 months, affordability has gotten much worse. In the first quarter of 2020, only 81 of the 414 largest housing markets in the U.S. were overpriced by more than 10%. 6 of these markets were overpriced by more than 25%, but none were overpriced by more than 50%, according to data from Moody's. From a historical perspective, it's clear that buyers are facing the most expensive prices ever, and rising mortgage rates are only making things worse. The last time average 30-year mortgage rates were over 6% was just before the 2008 housing crash. Until mid-April, mortgage rates were between 4 and 5%, but just a month ago, they were 5.49%. Fed officials can see what's happening, but the 9.1% inflation rate in June means that they might have to make taming inflation a top priority. As a result, the housing bubble will continue to burst, and things will only get worse in the industry. Schiff wrote that the number of homes under contract to be sold fell by 16% year over year in June, and the number of homes on the market went up. This is because mortgage rates continue to rise quickly. This comes after a 12% drop in sales in May and a 1% drop in sales in April. June was the 10th straight month of year-over-year declines in pending sales. Nationwide price cuts went up by 50% last month, almost doubling from the year before. Richer caused mortgage rates to go up and home prices to go up by 40% in the last 2 years. This is a toxic mix, and something has to give. The real estate research firm predicts that home prices in Boise will go down from 1 year to the next. This means that Boise will not only lose all of its gains from 2020, which is already happening, but also fall below its December 2021 price. At the same time, home builders are facing the huge effects of this slowdown. Builders from all over the country told me that now that traffic is slowing down, they're going to stop building. Author Robert Kiyosaki, we're already in a recession. The day of reckoning we've been told was coming is here. From now on, we're all going to pay for the reckless monetary policies that caused this bubble in the first place. Those looking for an easy way out of this mess should stop looking because there isn't one. We're headed for a disaster that will make 2008 and 2009 look like a Sunday picnic, and its effects will be felt for years to come.